everyone. Welcome to our next episode of the Inflection Point. I'm here with a very special guest, Justin Herlick. Justin, do you want to quickly introduce yourself?
Yeah, thanks, TJ. Thanks for having me. Really appreciate it. So, I'm Justin Herlick, CEO, co-founder of Pine. We are an online mortgage and real estate platform for Canadians, and we're creating a one-stop shop where people can get a mortgage online, find their home, figure out how much their home is worth, and go through their entire purchase with us.
Fantastic. Justin, I always like to start with the origin story, right? Because, what was that initial spark? What prompted you to go into entrepreneurship?
Yeah, so I've been now in mortgage and real estate for almost 10 years. My impetus to get into this really was when I was working in California. So I was at a company called Blend. And at Blend, we were the leading technology provider for mortgage companies in the US. This was big customers like US Bank, Movement Mortgage, Wells Fargo. And we helped them make their mortgage process more digital by providing them a technology platform. But what I found was the Canadian market was in a very different state. The incumbent players didn't really have an interest of working with a tech provider. They always thought they could do everything themselves. So we couldn't really get the traction for that company. And for context, like we were powering 1/3 of the entire US mortgage industry. So we were a big player, a publicly listed company, but we still had struggles in Canada. So as a Canadian, I grew up here in Toronto. I was really disappointed that other Canadians couldn't get the same experience that I knew was available in the US as someone living down there. So I thought, why don't I bring the whole experience back to Canada? I can start a company with our own brand, Pine, and really build the story around that and kind of serve Canadians directly as opposed to trying to build a technology and license it to other players like the big banks. So started the business 4 years ago, and we've been growing a lot since. We're in every province outside of Quebec. Our team is around 65 people today. And we're doing over 100 million mortgages, dollar value a month. So we've gone up to a decent size now.
Well, that's fantastic. In under 5 years, you've now, so 100 million, you're doing well over $1 billion actually a year now in mortgages. But let's start about that initial story. So you started off with Blend, and you know what? For a lot of people that are thinking about entrepreneurship, when you're in a great place, like you said, it was a publicly traded company, fresh out of school, you get to join a really great organization. It's hard to make that pivot to starting your own business. So what prompted that journey, and did that experience working at Blend have an impact on how you run your business today?
Yeah, definitely. So I worked at 2 startups before I started Pine. The first was Blend. I was there for about 3 years. And then I worked at another company in the US called Instabase, which was an AI company kind of before this current AI wave. And I was there for 2 years. And what we were doing was helping enterprise customers automate certain workflows, so like looking at documents, automating insurance claims, loan approval, stuff like that. And for me, working at other startups and seeing those companies grow from I joined Blend with when they had $2 million of revenue. I joined Instabase when they were 30 people. Seeing them grow from these small kind of core teams up to much bigger companies was really exciting. I got to see all the things that they did really well, the things that they could have done better, better for next time, and take those learnings and go into entrepreneurship. For me, it was kind of lucky timing in the sense of it was actually COVID. So everyone was working remote. I had moved back to Canada at this point. And when I was back in Canada, I thought, I'm back home. I think this is the right time to take what I saw a few years ago. Honestly, I thought that the opportunity to create an online way of getting a loan in Canada was going to be just, another feature, like another product line of an existing company. So when I had observed that, and then a few years later, nobody had still done anything with what I thought was a very obvious solution to a really big problem, I said, well, it's been enough time. I'm just going to do it myself. Because thinking about it, I was like, I'm convinced. I'm sure somebody else is going to work on this. One of the players is just going to start doing this. And, I'm just waiting on the sidelines to see if it happened. And a few years had passed. I moved back to Canada and nobody did it. So I was like, okay, this is such a thing that we can work on. I'm just going to do it myself. So I started the company when I saw that the opportunity was still there.
Right. And you know what? And the impact is massive, right? You scaled from zero to now you're doing about over $1 billion in mortgages a year, right? So walk me through that journey. I know from a founder perspective, going from 0 to 1 is probably the hardest thing anyone's going to do, right? And along that way, there's pivots, there's things that you do differently, there's key lessons that you learn. So let's walk through that journey from 0 to 1. What was that journey like? How did you start off? And what were some of the key lessons you learned along the way?
Yeah, so at every stage of the business, the challenges change, right? So the first 2 years we didn't even lend a single dollar. It was just building, right? And in those first 2 years, it was what's most important was that we could build all of the platform and people around us. So a product like ours doesn't happen alone. There's many partners behind the scenes. There's banking partners, there's service providers, there's regulatory things you have to do. And we knew that it was really important that we set the right foundation in those first 2 years. So to do that, you have to some money to pay people, right? So we raised money before we even really got going. And I would say in those first 2 years was the chance where the whole company could have just fallen apart. Like if we couldn't get key stakeholders to really take a bet on us early, then there was no way we were going to be able to offer the product that we offer today. We did have clarity of vision in the sense that we knew what we wanted to offer and we knew where we were going. So there wasn't ambiguity of kind of navigating different business ideas. It was just, can we get all the people around the table to support us? Once we launched, it was a slow start. I think had a clear vision for the product we wanted to offer, but we didn't know was how to get that product to people. So distribution sales was really hard in the beginning, especially when you have no Google reviews, no brand recognition, no customer referrals. Our type of business is really one where the scale helps the business and starts to build the flywheel. More people know about you, all these types of things. So the challenge shifted then to how do we get the word out? How do we get people to know about us? And what clicked for us was really focusing on a partner-driven distribution. So we're not a B2B product in a sense, but we found, hey, we can spend a lot of money on ads, but that wasn't super effective at reaching our target audience. What was finding people, other companies that had audiences that really needed our product, which was a low-cost, high-quality mortgage for qualified borrowers. And by tapping into audiences where we could structure partnerships where it was win-win, that was really the big unlock for distribution. And now that since our sales have been picking up and we've been doing a lot more loans, we're starting to see that. Our input costs are coming down. So we work with a lot of partners that determine some of like how low of a rate we can give you is determined by the cost that it takes to get that rate out. So now that we're bigger, that at least we're still not a big player and like there's a huge market. We're still very much at the beginning. But now that we're bigger than like 10 loans a month, we can start to drive those input costs down and consistently every month, every day offer one of the best, if not the best rate in the country, which is what Canadians care about. And we're also seeing those benefits on like the marketing and kind of trust side. So people are very comfortable referring their friends. They say, look how many like loans this company has done. They're at scale, and that all just continues to bring things down. If you can get more referrals, that means you're spending less on marketing, which means you can put more of it back in the customer's pocket, right? So it keeps going. And that's kind of been, exactly, compounds. That's what we've been working on now for the last year. So like every kind of chapter is a different flavor of challenge, but it's all been really fun.
So let's talk about that first chapter, right? So, you spent 2 years, you were in product development. What were some of the key lessons you learned from that? And, because 2 years is a pretty long time without revenue, right? And so how did what was the story that you would tell to, I guess, your investors to keep them on board and to also say, hey, listen, invest in us because, we're going to be breaking into the space, which is dominated by very large financial institutions, and we're going to be doing it a lot better.
Yeah. So, a couple of lessons. I think there was the perfect mix of like confidence and naivety. Like there were some things that had we known might have discouraged us from even starting, right? Because there were some challenges that were going to be difficult in terms of like how certain parts of the product worked or how certain aspects of like the financing worked behind the scenes. We knew just enough that we felt encouraged to get going. And we got that push from our investors saying, hey, you can go do this. But if we had known everything that I know now, there's a good chance like the business never would even got started because it was a really uphill battle.
That's an interesting point you made there, right? Right. So, and that's something that a mentor of mine actually told me too. Like when I started my retreats business, he told me the word he always likes to describe is, he says, you've got that naivety, right? And he says, don't take it the wrong way, right? He says, but he says the difference is when entrepreneurs have a form of naivety, it's almost like their shield. It's almost like they don't have that resistance that you would otherwise have if you knew everything. Because you would think of, all the reasons why you shouldn't do it versus all the reasons why you should go forward and do it, or why can't I, right? Was that
exactly right. So like a lot of people in the industry didn't think that our model would be able to get to this point. I always hesitate to use the word successful, right? Because I think there's still a lot to be proven. But even this point and the scale that we've gotten to, a lot of people were like, "Oh, you'll never get to that point." And in the past few years, you've seen a lot of other players try to come in and do what we do, and they end up pulling out. Like a couple big name American companies went into Canada, decided, hey, this wasn't the time, pulled back out, stayed there. But it's because we didn't know some of these challenges were going to be things that we were going to hit, right? We went in being like, we can do this. I did something related, but not exactly in the US. So I think that actually helps. But when we needed to get those stakeholders, like those other business partners around the table, I think knowing just enough or being able to point to other past successes was the difference between, a bank taking a bet on us and the bank saying, you know what, no, we're going to wait a few years to see if you get any proof points. Because if no one's willing to take that first bet, you can't get off the ground.
So, and that's a really important thing, especially when you're in a stage, when you're an early stage company, and you kind of need that big partner to validate what you're doing and to get you off the ground. So, what did you do differently in that pitch to that big enterprise client or partner that you were working with, and why did they take a bet on you?
So, what we did was we figured out the sequence of things that we had to do. Because to work with a bank, you need to be approved by an a mortgage insurance company. So we figured out the correct sequencing, and we said, this is where we want to be. And we kind of bit it off in pieces. So we got the ones that we could convince first on board for us. And I think that goes all the way back to, we raised money from great investors that had strong brand reputations.
Sure.
And I was lucky in that, like, even though I was an employee, I was at other places that had success. So being able to say, hey, look, I was at Blend, and Blend went from kind of an idea to publicly listed New York Stock Exchange company, I could point to that and say, I have some credibility, right?
Sure.
I wasn't the CEO or the founder or anything like that, but I have this past experience. I brought on some people from my network, and I was able to use those as the first initial proof points, people who knew me personally. So Greylock knew me personally. I'd known them for 10 years at the point where I went and asked them for money. And then having a brand name like that did open the doors. So we were able to kind of take these, chessboard pieces down one at a time.
Yep.
So that when we got to the hardest one, we said, well, we have, we've already done steps 1 through 8. We need steps 9 and 10 now. And so the sequencing, I think, was pretty important.
So you raised a really good point, that early investor. And I know for entrepreneurs, that's probably the hardest thing you'll ever do,
sure.
is that first investor. And I think sometimes, when entrepreneurs try to go for capital, they often go, try to throw it out to anybody in the world, right? Whatever sticks kind of thing. But you mentioned that it was super important for you to get this one sophisticated investor onto your table, onto your cap table. And they're the reason why, one of the reasons why that you were able to, see that initial success. How important is it to be selective in terms of the investor you have? Or do you suggest that you should just kind of go for anyone when it comes to capital?
So I think you have to look at like what you're prioritizing for. Sometimes, you just need money to pay salaries, spend marketing, get it done. At that point, if someone wants to be a passive LP in your business and kind of just provide capital and nothing else, that could be the right choice for a lot of businesses. For us, when we were starting, we wanted to work with people that we already worked with. That was actually more important than the brand. The Greylock has a fantastic brand, but that wasn't the reason we chose them. We chose them because we really liked the team and we had worked with them on prior businesses before. So they were backers, and they were backers actually in Blend and Instabase. So we got, it was just kind of luck of the draw that the 2 startups I went to had the same investors. That was one of the benefits of being in the Bay Area, is you get this, network of connectivity that it's not to be understated. Like, it is exactly what people say it is. I think what's most important is alignment, because some investors have different expectations. So you just want to make sure that you have the same goals. Typically, large multi-stage VCs, what they want is a huge opportunity that's going to create a world of change. They don't want like an incremental company that's going to do things a little bit better than the last one. So like, I think alignment between the money you're taking and the goals that you have are really important. You see a lot of people like online these days on LinkedIn or like Twitter or whatever. They're like VC bashing. They're like, oh, your business doesn't need VC, or like your business doesn't need, investors don't take them. They're going to dilute you and you're not going to do anything. It kind of depends what your goals are and if they're aligned. So if you're taking money from whoever you're taking money from, that person had to earn that money. That it means a lot to them. You want to make sure that their fund strategy or their investment strategy is aligned with your business strategy. And I'm very aware of that. Every time I go out to a venture capitalist and I raise money from them, I say, look, we're going for a big swing and there's a chance it doesn't work out, and you're okay with that because that's the type of investor you are. But if you go to different like people, they have different expectations. They say, you know what, I just want to make 10% return consistently year over year. I can take a little bit of risk, or I can take a moderate amount of risk,
Sure.
but I don't want 40% IRRs. I want 10, and I'm willing to accept these types of business risks. So it's just, you got to match your needs with the needs of your investors. Otherwise, that's, I think, when you get in trouble. Like, people have like the wrong expectations.
Yeah, and I think that's pretty big in the venture world, or when you're trying to raise capital, right? Especially if you're going to, let's say, not an institutional investor and you're trying to raise, an angel round or family office round. The expectation is now you're raising money from someone's personal capital.
Yeah.
Right. And so their expectations may be like, hey, listen, I want to get an exit in a few years, or I want some kind of dividend stream or something. Versus if you were to go to an institutional investor, they have patient capital, right? So capital that can be around for maybe 5 to 10 years, right? And they're willing to sit on it to take a bet that it's going to work, that it's going to fly. But in your case, it certainly has flown. Like, you went from zero to $1 billion. So in that early journey, you raise the capital, 2 years, you raise the capital, you build the product, and now you're at a stage where you got your partner that will get you going. What was that next one, or that next sort of milestone in that business journey for you?
So the next milestone was really just starting to hit a scale. So we brought on a really big partnership. Many people know of it, but we work with Wealthsimple. Awesome brand, awesome platform, fantastic team, really kind of the most innovative fintech in Canada, I would say. And the scale that they brought to us at first was challenging, because they are as good as I just said. So we had to do a lot to hit the bar, and it taught us how to get up to scale. And that was a big contributor to our success. And what it also did for us was bring credibility to our business, because we can show an amazing partnership for Canadians. And with the growth that came with that, again, we were able to just continue to kind of accelerate our business that way.
Yep.
So the next scale was going from 10 million a month, which would be like, just over 100 million annualized. Some brokers do that on their own, to the billion. And so we started lending like January 2023, roughly. So it's like 2.5 years to get to the billion, and now we're at like roughly around $1.5 billion run rate. But learning to manage that, because there's different problems. So it's like, okay, now you have more of a distributed sales team. Now you have mortgage advisors across the country. You're dealing with time zones. You're dealing with like vacation, holiday schedules. You want to make sure people are always available. It's a different set of challenges versus the first set of challenges, which is, how do I even get off the ground? It's, how do I scale a really good customer service, provide value to people, and continue to do that over and over? That was, a challenge. And I was fortunate in that I saw those similar challenges at the other startups I was at. I saw their revenues grow, 50 times, from a kind of a side seat, not as an exec. And knowing that scaling brings challenges, but you will get through it. And what's important is to keep your gold star metrics and to focus on that and not get distracted. I think was important. I was able to take those learnings from the other startups and use that from when we went from 10 to 100 plus.
Yeah. Every startup and every founder goes through an inflection point in their journey when you start to realize, look, this is going to work, or this is, oh boy, we got to pivot a bit. So let's talk about that for you. What would you say that first inflection point was, and what would be that next inflection point in your journey?
So I think there was an inflection point when realizing that paid marketing wasn't going to get us there.
Right.
So it's a tool that works for a lot of businesses. For our business, we found that particularly the payback periods were really bad. So if you're spending a lot of money up front on Google or Meta or whatever, and you're getting a lead, well, typical mortgage only closes in 45 to 100 days from when you first talk to that client. And then people think the revenue stream's all up front. It's actually not. We get part of our revenue is making sure that the loan is performing as expected. So we get paid from our partners to make sure that the loan's being administered correctly. So it's a big part of our revenue. So you actually spend a lot of money going into making a mortgage. So on a given time period, you have some level of payback. So we realized that paid marketing, one, was expensive. Two, was very fickle. So what could work 1 month, your ad copy or your visual copy, it might not work, and then you've wasted a whole month and you're set back, right? So it wasn't that repeatable. You could have these fluctuations. They change the algorithms. All these things mess you up, and the worst part is your cash is out the door already. So you've spent the money. We're more focused on a partner-based strategy now, where we can kind of level out the cash flows of our expenses with the cash flows of our revenue.
Sure.
So it actually allowed us to move faster and with more confidence, most importantly. And with that, that was kind of like an inflection point, realizing that was a strategy that a lot of other people tried unsuccessfully, and we had to do something different. Otherwise, we would probably meet the same fate as them. Second inflection point now is like, now that we're at scale, is figuring out what we do next, right? So we acquired a company called Properly, and they were also a fintech, prop tech type of company. And we brought that business in-house that we could offer not just mortgage, but real estate. And the thesis that I'm still proving out, but I'm very confident in, is that mortgages and financing, while important, is really boring. So like, nobody really wants to talk about their mortgage. It's like, I have it, I pay it.
Sure.
The less I talk about it, the better, right? Yeah. But people, especially Canadians, are super excited about real estate because it's always up, down, some new development, your neighbor's home, your home, what's going on in renovation. It's cool, right? That's why HGTV is such a successful media platform, and they're in like every country in the world because people love it. It's where you live. It's such a big part of your life. Or like mortgages are like hopefully just an afterthought. Yeah. And so what we did was we acquired a real estate brokerage, technology real estate brokerage, so that we could expand our product offering. So now when you go to our website, you can create one account, and that one account lets you view homes for sale, figure out how much homes sold for, do some analysis. We can connect you with one of our real estate agents that are part of our brokerage. And we have a much wider surface area of marketing opportunities. Yep. And we're able to move ourselves upstream. And I can give you a stat around this. Sure. So before we launched the real estate side of the platform, we were getting 20, 30,000 clicks a month, just organically. Now we're getting well over 130,000 just from turning that on, right? So we 5x'd our, with almost no effort. Really, just by saying hey, we have all these new pages about listings and home sold prices and stuff like that, we were able to increase our brand exposure 6x, literally overnight. It was pretty crazy if you look at our Google Analytics chart. And that's the first validation that I have that this acquisition was the right play, because we just want more people to know who Pine is. Right. Because the biggest reason why we're if someone gets a mortgage and it's not with us, the biggest reason is that we weren't even in the contention. People didn't even know that we were an option available to them. So they went to their bank, they went to their broker, whatever, and they didn't even evaluate us. So that's kind of a long answer to a few different questions there. But.
Yeah, well, actually, I want to noodle on that acquisition because, it's a little somewhat atypical for a startup that's just launched, right? You said 2023. And then about a year and a half later, you're already thinking about an acquisition of something that's not competing with your business, but something that's what you felt, the bet that you took was, this is going to exponentially help my current business grow. It's in a different business line. It's in a real estate line. So walk me through what that conversation was like, because I'm sure you had to convince a few of your board members and investors and so on and so forth, and also yourself, right? Buying a company is, it's one thing, but buying another startup, which is what they were, is a different thing. So what was that thought process like, and what made you think that, I need to go out and take this company?
Yeah, it was interesting. I wouldn't say we take it. We took it. We
or buy it. Sorry.
Yeah. No, it's a funny term.
Yeah. Sorry. I meant
we. I think it was timing. It was really interesting timing. Yeah. So we knew that we had to do more because our vision. Even you can go back as far as our seed deck, our earliest decks. The vision was always, how do we help people own their homes, feel confident about that, and support them throughout the entire journey of owning that home. And obviously, real estate is a huge part of that. Finding the home, going through the buying process, which was very stressful for most people. So when there was an opportunity to kind of acquire or merge with them, it was good because we really respected the team. We really respected what they had built. The brand was amazing. They had great technology. So it was all these things. It was just an interesting market opportunity. We all know what's been happening in Canadian real estate. Sales have slowed down. It's been tough. So there was an opportunity to kind of merge or acquire them. And we went to our board. We said, look, this probably won't have any impact for the next year, but long term, this can accelerate us because we really want to be in this part of the business, but we know how much work it is to get things off the ground. So we can spend some money today, have the foundation already laid for us, or if we didn't, we could have went after and pursued that opportunity organically. I think that's for a lot of companies, their options, acquire or build right. or build or buy. And for us, we're this will just get us there faster. And I think what kind of clicked for me was if we don't buy, we will probably always keep punting this. Like we will just always say it's like next year's priority, and we'll never actually get to it. But this will force us to. So we structured a deal that we found acceptable to us, acceptable to the sellers as well, and we were able to move forward with that. And it's still TBD. Like I think we're seeing like those successes now, so I'm really excited.
Yep.
This is a good time to chat. Chat with me in another year, and I'll tell you how well it's going. But like people say, oh, was it the right call? I'm like, I don't know. Like I don't know until like 3 years from now if it was the right call. But at the time, it was the right decision for us.
Fantastic. Yeah. And you know what? It's you sometimes, and that I think is also another inflection point, right? It's like you're at that stage where it's like, do I buy this company? Or do I continue on this journey, which is, pushing this, the product the core product that I've built. And you've now scaled it to $1 billion to $1.5 billion, over $1.5 billion in mortgages a year. What makes you different and appealing to Canadians? Like, what is that one reason that if someone had to choose between York, Pine, and a TD or RBC or whatever, like, why choose Pine?
So I can tell you based on exactly what our clients say. So
Sure.
one thing we do is every time someone gets a loan from us and they fund, we send them a survey. Like, you get this with everything, your airline, your hotel, how was your check-in, how was your stay? How was your experience with Pine? We have a 92 net promoter score for funded clients. That means
Wow.
people are really, really happy with their experience. And what they always say is, insert advisor name. So it could be Dana, Bobby, Kyle, whoever. Kyle was amazing to work with. He was extremely professional, knowledgeable, got me the best rate right off the bat. That's the big thing. People, when given the choice, will choose not to negotiate. Mm-hmm. Negotiating for a lot of people is uncomfortable. I think for people in business, it's part of day-to-day life. But for a lot of people, they're like, I want my mortgage to be straightforward and transparent. I don't want to go back and forth 100 times. Mm-hmm. But that's what most of the big players make you do. They will sometimes bring the rate down. It depends on a lot of factors that are out of your control. How the bank's doing that month, what their priorities are, how much deposits, like all these different things, right? So when they come to us, we give them the best rate right away. They have great, knowledgeable advisors that are always there for them, and the technology just makes things so much easier, right? So you can upload your documents at 2 a.m. in the morning. You don't have to email them to some branch staff, or you don't have to print them out. You don't have to go to a branch to sign the paperwork. So it's convenient. And it's low rate. People want to save money. It's a financial product. I totally get it. Mm-hmm. We've put all of our effort and innovation to drop costs as much as possible. So we've automated a lot of things on the back end, mm-hmm. so we can take those savings from saved hours, saved vendor cost, and put it back in the form of a saving to the client. Because I'm of no illusion. It is a financial product that is very comparable across institutions in terms of what you're actually getting. But the process of getting it can be more or less painful.
Yeah, so let's talk a little bit about your personal growth as well. Obviously, we have the business that's growing too, but personally, right? You've worked at a few startups actually before you embarked on this journey of entrepreneurship. Walk me through what that personal growth is like. Like, what are your non-negotiables with yourself personally, and what is that? Walk me through the day in life of Justin Herlick. Like, what will be a typical day? What time do you get up? What time do you start your thing? Do you have a standardized schedule?
I don't know myself like this. No, I like to stay up late. I don't have a crazy morning routine. So for me, typical day is, I get to the office somewhere between 9 and 10. Mm-hmm. Different teams, engineering teams have this stereotype of staying up late and getting in late. I think that's true for some. Some do like to work early. But for me, I definitely fit more of like a software engineer bucket of personality. What I try to do is at the beginning of the week, figure out what all the team's priorities are and course correct. And then if there's something they're working on that they shouldn't be working on, that we need to say no to, I try to get that out of the way at the beginning of the week, mm-hmm. to save them that time. Because the worst thing you could do is like work on a project for a while and then realize it wasn't actually going to contribute. And then every week's kind of different. Personal growth though, a couple things that are really important to me. I like to stay healthy. So I try to go to the gym or work out 3 to 5 times a week. I think that's really important. So for me, this is definitely getting into the personal side, so I don't know how helpful this advice might be to anyone in your audience. But for me, just make it as low effort as possible. So I go to a gym as close as I possibly can in my office. I have to spend a little bit more money, but I got like a really great gym, really close, had all the amenities I needed, open all the hours I needed them, so I can go right there. So that's what my routine looks like. But I think that's really important, at least for me, is that I have this kind of consistency. I'm also a big believer in like preparing your own food, making sure that what you're eating is healthy. Like it's like I don't use any of these food delivery apps. Nothing wrong with them, but like I like to be in control of what I'm doing. So People are surprised when they hear that. Like, okay, you work a long day at work, then you go to the gym, then you get home, and every single night you're cooking. I'm like, yeah. So that's like my kind of practice.
That's your daily routine. Yeah. Let's talk a little bit about the venture and startup lens. There's been seismic shifts in the past couple of years, right? With AI coming in and just, in many ways, I feel that, and I was talking to an executive at a pharma company, and he told me something that was very powerful, and I just wanted to get your comment on this as well. He told me, TJ, people are looking at AI the wrong way. And I said, what are you talking about? And he told me, he said, people think AI is going to replace jobs, but I think they're looking at it wrong, because he said, think of AI as that $1 trillion sort of engineering team that you have at your disposal. And A-level talent will find and create A-level products that much faster. But you'll have, let's say, a C-level talent. They're going to use that $1 trillion, engineering team, so to speak, and they're going to basically create a C-level product that much faster. Right. So what are your thoughts on that? Is that something that you see as well?
Look, it's a tool that I think it's an amazing technology change. I'm very, very excited about it. But in today's world, as like a normal business, let's call it like non-technology business, the challenge is getting it to work for your needs. And I think we're in this like weird transition phase where like AI kind of didn't work a few years ago. Now, like the technology capabilities are definitely there. Like these models work. They are incredibly powerful. But where we're in this middle range, which reminds me of like some of the early cloud projects I was working on for financial institutions, is like how do you get it to work for your business? Mm-hmm. And like I think that there's still no playbook. Everyone is taking their own approach to it. And just like a lot of other technologies that came out, there's some early adopters, and it can take a long time for incumbents to actually bring it on. Now, I don't actually have any like proof points I can point to, but you're hearing that this is being adopted way faster than other technologies that have been. But in my observation, just from using it at our business, it's how do you use it correctly? And a lot of that is engineering your business processes around an inference-based system. So I have, we're innovative, we're a technology-driven company. We have a lot of software engineers. We're doing a lot of these things, but we work with a lot of incumbent companies, and they look to us and they say, hey, what are some things that you're seeing that are interesting with AI? And I say, look, it is hard for a traditional company to use because it is a big mind shift change in software developing capabilities and processes. And I'll explain what I mean. Typical software engineering practice. You have requirements. You build your code, and maybe it's waterfall or maybe it's agile, whatever. You evaluate it against a set of test cases. And okay, 1 + 1 = 2. Done. Correct? Test case passed. If the customer clicks the cancel button, the application is canceled, right? So typical way of building software, very procedural, step-by-step. You cannot use those techniques because these are non-deterministic systems, which means that the same input results in different outputs every time you run it. Right. So you can't apply the same software development techniques that you applied in a procedural, old way, non-inference-based way, which means that how can you feel comfortable putting it in front of your customers, in front of your critical systems? You have to build an entirely different system of testing and evaluation. And there's ways to do this. It's still kind of in development. Like people are coming up with different techniques. But you have to say, hey, look, let's do like a really simple example, a call summary. I think a lot of companies are working on this. The same LLM with the same inputs on the same call will not give you the same summary of that call every single run, right? Now you can turn the temperature down and it's very similar, but the exact wording, if you run it multiple times, it'll give you different. You take two different LLMs, you give it the same call, you say, summarize this. They could both give you correct output, but they are giving you different answers, which is not the same way that people used to build code where it's like, hey, look, like if I'm ordering a plane ticket, did the ticket get processed like exactly how I wanted it? So it's a completely different mindset. Right. And I think a lot of organizations are not comfortable with non-deterministic workflows. So getting them comfortable and figuring out, hey, this is how you test, this is how you build evaluations, this is how you iterate, this is how you feel comfortable, this is how you look at success, is like the huge change in this. And it is actually really scary for a lot of institutions to put these systems in.
Well, what I'm actually also seeing is like there's been such a big spotlight that's set up on companies that are AI driven in a sense that that's their core revenue driver,
Yeah.
right? But I think there's a missing piece here in that boring businesses, and I'd like to classify my business and maybe to even a certain extent your business, which falls under that category of it's just a mortgage, right? It's we're talking home mortgages and whatever. What people don't realize is that AI can turbocharge your internal operations, and what would have been a very low margin business like in my case, property management is sticky, and working in the retreat space, it's a pretty sticky business, and with low margins. But now with stripping away the complexities in the operations by using AI to automate things, you now have wider margins, right? And so I think that's a really cool innovation that's come out of and that a lot of people aren't really thinking about is the fact that you may not get that AI multiple, so to speak, if you are, a revenue generating business that is focused on selling an AI product, but you can use AI to widen your margins and become more profitable, right? And I think that's one of like the core lessons I think that people and maybe even investors to a certain point who evaluate and have to choose between, do I pick another wrapper, another GPT wrapper versus a company that's now AI enabled versus they're building AI, and there's an opportunity there. So I think there's an opportunity where companies can use AI to become profitable faster, which leads to the point of startup journey, right? Now you started building your company, I guess, before this just before this massive AI boom that just that took off. If you were to do it differently, let's say if you were to start that company 2023, ceteris paribus, right? All things being equal, and you were to start with, let's say a couple of years later when, the GPT and GPT-3, GPT-4 was out, you think you would have had to raise less money than before to build your company, or is it would have been...
No,
No?
I think I would have had to raise, not what I thought the question was going to be. I think we would have had to raise an equal amount. I think we could have saved more.
Sure.
Like we could have gotten certain things done faster.
Mm-hmm.
Right? Like there was no like Code Assist or Codex or Copilot, any of these products when we started. So we had to spend more time writing code. That's like one aspect of the business.
But you could have built it faster, maybe?
Could have built it definitely faster. So yeah, maybe we could have raised a bit less. But I think another question that's kind of on a similar frame that you could think about is like, would you have built anything different? And I think we would have, right? So we've built a really strong system of record. That's kind of our core competency. But now we're way ahead of everyone else in that like their systems of records are on mainframes, and there's multiple different databases. We have everything in one place. It's really nice. I think we would have started thinking more about how do we tap into the unstructured information that we have on our loans. So it's like files, like pay stubs, tax returns. That's all unstructured data that we need to turn into structure to approve a loan. A call, like just a call, is unstructured. It's an audio file. Or it's a text transcript. I would have focused like more on like that, knowing that, hey, this is gonna be really valuable. We can extract information out of, but we're making those changes like very quickly and focusing on so we can bring those automations out.
Okay. Going back to the venture, like what do you think that big blind spot is for founders when they're trying to scale from that first $1 million in revenue to the 10 million or to getting to the $100 million? What do you think that blind spot is?
Well, I don't know if I'm the best, like if I have the best perspective, but for me, the challenge in going through all those phases is understanding that like as a founder, your job changes dramatically. And I think like I was lucky, and I'll take this back to what I said earlier. I was lucky to have been at other startups that scaled up and did have success and did grow revenues very much from like 1 to 10 to 100 plus. But I think some people, and founders particularly, they get into the business because they like that early ground game of like, I got to build something, I got to hustle, I got to get things off the ground. And they don't realize that you got to keep up with your own company, right? Like just because you were the right CEO, right founder when you started it, you could, if you don't adapt, you might not be the best person to be running the business in 18 months, in 36 months, and whatever. So I work with our president and CFO, Brian, who's actually my old boss from Blend. He came over to work with me. And we work together on making sure that I always have the ability to say, hey, look, what I was doing last year is not necessarily what I should focus on this year, and evolving and keeping up. Because if I can't do that, I'm not the right person. So I need to make sure that I can always be changing at the same pace of the business. And a good way of looking at it is like if you're doubling every year or something, your skills and your abilities and your people need to double with you as well. So if you have a leader and that person's leading a function like finance or product development or engineering, whatever, they could be the right person at that time. In 18 months, if you're growing as fast as kind of the numbers you described, that person needs to grow at the same pace, their own ability. And if they can't, then maybe you need to find, the right person that can take that function. And I always think it's better for people to grow with the businesses. Actually, a really fun stat that I always like to tell people is every manager at our company was an existing employee. We did not hire a single person externally for a management role. And that could be any level of manager. Mortgage advisor manager, underwriting manager, everyone started as an IC and grew up. Yep. So I do believe in this, but those people have kept up with the company, which is exciting.
So that goes into a perfect segue into team culture, right? So, setting the culture, like it's very difficult to convince someone to work with a startup. It's probably the hardest thing you'll ever do. And in your case, you had to obviously, launch your product 2 years into that journey. So how did you convince the earliest employees, and how did you attract the top talent to work for a company that had, at the point, zero revenues, and focusing on an industry that, is pretty mature? It's the mortgages industry that you were clearly disrupting. So what was that conversation like, and what was that sort of pitch that you had to do to your employees?
Yeah. So a lot of our early people and leaders of the company were people that I'd previously worked with or known personally. So I always tell founders, like, oh, how do I hire my first XYZ? I'm like, look at your network, because those are the people who are going to believe in you the most, because they'll know you and you're past that kind of first level of trust. So that I definitely relied on. People that I knew that I had worked with, I really liked them. They enjoyed working with me, and started there. As you get bigger, or as you need more people outside of your network, because you might not know everything for every role, again, same kind of strategy, first degree referrals. So, okay, I didn't necessarily work with our now head of engineering, Hayden, but our head of product, he was head of product at the time, he's our COO now, but he had worked with him in a past job. So he said, I can personally vouch for this person. And then in terms of like recruiting and selling and the division and all that stuff, people should generally align with your problem. If they just want like another job and they're just tired of theirs, and that's not, I think, a good enough reason to stick around, they probably won't make it through the ups and the downs. So they have to resonate with the problem that you're solving and believe in like the core value. But even past that, there's a lot more that goes into it. I think you have to find, as a recruiter, like, an early stage founder, you're a recruiter, why are they interested in leaving, right? And then play on that. So a lot of people that join Pine is they're tired of how slow, how bureaucratic other institutions can be, and then you sell on those points. Like, okay, so it's an engineer, they really want to build things naturally. You sell them, look, you don't have to go through 15 approvals to bring on some new tool. You want to bring on a new tool, you get to bring in that new tool. You find why they're upset with what they're current at, because if they're not upset, you can still recruit them, but it's a lot harder. If you find those holes, those gaps, and you convince them, honestly, why those gaps will be filled at Pine, or with your company. Say, hey, look, you're tired of how slow things move. We move so fast. We release multiple times a day. You only release a couple times a month. Like stuff like that.
Yeah, and so in terms of setting the team culture, you've grown to now, over 60 people now, and maybe close to 70 people. So along the way, the team has grown substantially. So walk me through what that culture is like, and what are you looking for and most proud of in the team that's there? Like, what would be the core competencies for someone if they wanted to, let's say, work with Pine?
So I always tell people, you have to come with an innovative or open mindset to the industry. That's like the number one success factor. Like, you join us because you believe that the way that it has been done is not necessarily the right way, and that there's opportunities to make everything better. So what I really try to avoid when hiring is people who say like, oh, well, we're going to do it this way because that's the way, like, we did it at X. And if that's like if the rationale for doing something a certain way is this is the way that they did it at X, that's like that's like a biggest red flag for me. It should be, this makes sense to do because there's like just a first principles reason. There's like a core understanding of like, this is a better approach to doing it. Or, it's always been done this way, but it's always been done this way because here are the reasons why it actually makes sense. Because, a lot of things that exist for a reason. So like open, innovative, understanding that things are changing, understanding that your role is going to change every few months. There's going to be a new challenge. That's like what I look for. So
we're at an inflection point now, outside of just our jobs and our businesses, but as a country. Right, we're at a pretty big inflection point. We've got the Trump tariffs that are hammering down. We've got an economic contraction, is what the Bank of Canada is saying, that's happening. mortgage rates are still pretty high. They're saying 2026 is going to be a massive year for renewals, especially for all those big COVID houses that have, the houses during COVID that people purchased, right? The renewals are coming. What are you seeing, and what do you think is going to happen? What are some of the perspectives you can offer around that?
Yeah, I see a lot. I see a lot of this because we talk to so many people every day. So we definitely see some people experiencing the shock of a renewal. So rates were very low during COVID. Those loans are coming up for renewal, 3 or 5 year terms, and people are looking at how they can manage that for their household financing. So we definitely see people that go through issues. Like I had one today. They were scheduled to buy a property. Appraisal came in way low because they made the agreement to purchase that a long time ago. So there's challenges, right? And I think that's why a product like Pine is resonating so much, because we give people a good solution up front. We work with them, and we can be kind of a way for them to handle, absorb some of that shock. Luckily, rates have come down from like the peak, which is really good. But yes, the economy does have some fractures, but overall, I'm still very optimistic. We see people with strong incomes, their jobs are doing well, they're doing well in their careers. Yes, their mortgage payment has gone up, but hopefully your pay has gone up as well to match some of that. Not always the case, of course. But I think there are still a lot of like optimistic things to be through. Yes, there's tariff headaches and there's like whatever going on, but they're hopefully short-term problems. I think there are like also long-term things that we need to fix about the Canadian economy to have long-term success.
Well, what would success look like in, let's say, the mortgage industry? I mean, that's a pretty loaded question, and I think we could spend like an entire podcast on just talking about that. But what are some of the holes that you see right now in the mortgage industry, and how does Pine help, fix some of those holes that are there?
Yeah, I mean, there's still a lot of struggles. So like paper documentation or file documentation for income verification, employment verification is still very antiquated. They have a lot more tools in the US, whether it's open banking or there's certain providers that can help you digitally confirm employment. So we're still kind of like patchworking things here. I think certain parts of the process are a lot slower than they have to be. So when you switch mortgages, they come up for renewal. You have to get, if you want to switch, you have to get the other one paid out, which is a relatively manual process. It's pretty frustrating, and sometimes it could be delayed, cost people penalties. So it's like there's a lot to focus on, these small input pieces, in terms of like bringing everything into a modern era. One thing I'll say is the rules are very confusing. So there's over $1 million, under $1 million, different types of mortgage that you qualify for. If I could fix one thing, I would consolidate all the rules around mortgage insurance to be consistent, because right now it's quite inconsistent. It's like, well, if you're a first-time home buyer and you're buying a new build, or it's under $1 million, but it's less than 20%, it's like very, very confusing, even for people in the industry.
Yeah.
And those changes came in recently, and they were in a step in the right direction, but now they're broken up and fragmented. So that would be like my one area to fix.
Fantastic. Well, there you have it, guys. We've now heard from one of the top entrepreneurs in Canada, Justin Herlick. Justin, thank you so much for your time today, and thank you for stopping by at the studio. And for guys, if you're looking for a mortgage or you're thinking about a mortgage, Pine. Visit Pine. They're going to help you, and you're going to save big as well. So thank you so much.
Thanks, TJ.
Cheers.